We were talking about the inventory systems because we were talking about merchandisers. Now it's time for us to start looking at the accounting for all this. And one of the concepts that's very important when we talk about inventory is that we need to be sure to put all the costs associated with the inventory into one account called inventory. And it's probably pretty obvious to you that when you make a purchase, if you paid for it with cash, you would credit cash and you would debit inventory. But it may not be quite as obvious to you that all the costs that go along with the inventory to get it into a sellable location and sellable condition should also be put in this inventory account. So this transportation cost they're talking about here in this slide, that's the freight costs. What you pay for getting the merchandise into your stores, that becomes a part of inventory costs. If you return something and you don't like what's been sent to you for inventory for sale, you can send it back to the vendor. Well, then you need to reduce the inventory. If you have an allowance and they say, well, you don't have to pay us quite as much for this inventory, well, you adjust the inventory account, you take it down, reduce it for this allowance that the vendor, the seller of the merchandise gives you. You also might have a discount that's given to you because you are able to pay for the products that you buy early. If you pay for it on time or early, they may reduce the amount that you have to pay them. Well, if that happens, you reduce your inventory account. So all inventory related transactions are recorded in the inventory account. Some of these increase the value of the inventory, which may be thinking here about freight, and other things will reduce it, like purchase returns and allowances and purchase discounts. Walmart here received $10,500 worth of bikes purchased on account. I know in some of these videos I've been talking about Walmart and I've been using numbers that are just ridiculously low for this company that is a multi-billion-dollar company. So it's kind of a tongue-in-cheek when we see something like this and receiving only $10,500 worth of bikes. Be more likely to be much greater than this number, right? But as an example, Walmart receives $10,500 worth of bikes purchased on account. How do we handle this? Well, it goes into inventory, it goes into accounts payable, because when we see the terminology on accounts, we know it's accounts payable. And then we can also record it in a journal entry like this. And transportation costs. So now Walmart also has to pay the truck firm. So it's not only the amount being paid, say, to the seller of the bikes, it could be paid to some other separate party that is delivering the bikes to them. So they pay $400 to the trucker. It would probably be a shipping company. So the shipping company they're paying $500 cash to. It's an inventory swap. We are swapping out our cash and we're paying for it, and we are adding this cost to our inventory value. Crediting cash, putting it in inventory. So, to repeat what I just said a moment ago, the rule is that all costs associated with getting the merchandise to the location and condition for sale become a part of inventory costs. Another example for you is, what if it were a dress shop, and what if merchandise was brought in that had wrinkles, it needed to be ironed, or it was soiled, it was not clean, but yet it was sellable, just wasn't in a sellable condition at this point in time, it needed to be fixed or refurbished. What about those costs? Again, all the costs of getting the merchandise to the location and condition for sale would be a part of inventory cost. So having it pressed or ironed becomes a part of the inventory cost. Having it sent to the cleaners to be cleaned, it becomes a part of inventory cost. Another example would be having the bikes, in this case, assembled in the store. That becomes a part of inventory costs. So here we have a credit to cash, we have a debit to inventory. So the total cost of the bikes is not just the $10,500, it's the $10,500 plus the $400. Walmart then decides to return some of the bikes to the supplier. And because they return, they don't have to pay for them anymore, so they get a reduction in the balance owed. This is a purchase return. So up here they say purchase returns and allowances. Technically it's purchase returns and purchase allowance, and this example they're giving us here is a return of merchandise. When they return this merchandise, they take it out of inventory because we no longer have it in our inventory, and we record it then as a reduction also in the amount we owe. Now, if this were done under the perpetual inventory system, what would be happening is this merchandise would be scanned as being taken out of merchandise. So we would use a scanning device, and when the merchandise is shipped back to the supplier, it would be scanned. Our inventory records would then be updated. The journal entry then is really the reverse of when we purchased the merchandise. When we purchased it, we had a debit to inventory, we had a credit to accounts payable. Here we have the opposite. We have a debit to accounts payable, credit to inventory. So we're reducing the amount we owe this particular supplier. Purchase discounts. What are purchase discounts? Well, now Walmart is going to be paying the bill. This particular supplier has some terms, and the terms of the sale up here are 2, 10, net 30. So we will get a 2% discount if we pay within 10 days, and we need to completely pay our bill within 30 days. And it says here we paid within the discount period. The discount period is 10 days. So we get to take 2% off of what we pay for the merchandise. After returning the $500, and they gave us credit for having returned this merchandise, we then owed this company $10,000. $10,500 minus $500, $10,000. A 2% of the $10,000 is $200. So now what we need to pay this particular supplier is $9,800 because they are going to let us take $200 off, or 2% of $10,000. Now, if we didn't really pay this extra $200, then we need to adjust also our cost of inventory. So what we're doing is we're going to adjust downward our inventory cost. We are going to pay only the $9,800, but we have, meanwhile, this account payable balance, which is $10,000. From the two transactions we had previously. You may want to go back and do that in a T account to see where the $10,000 is coming from by looking at those two separate transactions. Now, when we do this then, as I said, it's really cool about accounting because everything is made right. In this case, our balance in accounts payable was $10,000. When we pay the $9,800, we get rid of the $10,000 that we owed. We no longer owe this vendor anything, and our inventory balance our inventory for this merchandise has been reduced. I believe in addition to the $10,000 in our inventory account, we also had some costs associated with freight. So the value in our inventory account is not really going to be $10,000 minus the $200. I believe we also had an adjustment that came into that account from the freight costs. So here again is a recap of that inventory then. We had $10,500 in that original invoice from them when we made the purchase. We had freight costs coming in. They gave us an allowance of $500 here, and we applied it. This was for returning. I believe we returned merchandise here for $500. And then because we're going to pay our bill on time, they're going to give us an additional $200 off. When we do all of this, we find that our net purchases for this time period is $10,200 and our goods available for sale becomes $15,000. This is a bit simplified, so I think the numbers here tie back to what we had in the previous PowerPoint, the one right before this, when we showed goods available and then we showed ending inventory and cost of goods sold. What I wanted you to see in this is that this is where these numbers are coming from. And when we say net purchases, we're really talking about all of this combined and added down, and these two would have been subtracted to get this number, $10,200. For Walmart, this would be just one simple transaction. Again, tongue-in-cheek, think about Walmart, all the different inventory items they would have, all the different transactions happening here, and what the total amount would be for this. It's volumes and volumes of merchandise coming in and out of their stores on a daily basis, hourly basis even. So beginning inventory plus purchases plus freight in, because freight costs are the costs that are necessary to be getting this merchandise to a sellable location and condition. We had returns of merchandise, and here they have the proper caption, purchase returns. And then we had the discount because we're agreeing to pay it on time, which gives us the goods available. So goods available after all these transactions becomes also the inventory balance. Merchandisers earn revenue by transferring control of merchandise to a customer, either for cash or on credit. So we're going to talk for a moment here about revenue recognition for merchandising. It's not as easy to think about it. When you think about a service company and you say, when earned, well, that's when they do the job. You know, when the dry cleaner cleans the clothes for the customer, that's when they can say they have earned it. If you had someone come to your house and clean your carpets, when they clean the carpets, they've earned it. If you had someone coming to your house and painting your walls, when they paint your walls, they've done it. If you have someone mowing your lawn, when they mow the lawn, they've done it. So with servants, it's fairly easy. We don't have that same thing with merchandisers, and so we tend to think of revenue as being earned with them when the customer walks out the door with the merchandise. So at Walmart, when you walk out the door with the merchandise, that's when we say that Walmart has earned the revenue. For merchandisers who are shipping goods out, they oftentimes talk about the transfer of control. And it's not always just delivery, though. So if you were a wholesaler selling merchandise to a retailer, for example, you would have different terms than just possession. And you would use these terms maybe. FOB, shipping point. What does this mean? It means when these goods are shipped is when we assume that the ownership has transferred. So it's not taking delivery anymore, it's when it is shipped. So when it leaves the seller's shipping department, it becomes the buyer's. The other terminology is FOB destination, which means when it gets to the destination of where it's being shipped to, then is when it changes hands. And when it changes hands, when it transfers, is the point at which revenue is recognized.